How do I play this volatility that's surrounding all the stock's earnings in this upcoming week and last week? Well, I'll give you an example. Most people, a company like GE will be reporting, it's expected to be largely positive and they'll buy some calls. And in this case, GE was trading up in the post-market after their earnings, I believe 8% or something similar to that. So those people did make money. However, they put themselves in a position where they're either going to make money or lose money. You lose the money you paid for the call, or you make money selling it in profit, right? So I take a different approach, a lot more conservative when I'm trying to play these earnings. And what I'll actually do is sell a credit spread with a week-long expiration about 8% away from the market price. So when GE was trading at roughly $178 per share, I'll get into the market and I'll say I'll sell a credit spread, okay? So I'm selling this and it's going to be roughly at 165 and 160. That's my spread. This nets me a certain amount of premium, okay? And yes, in this case, my potential profit is capped because this is a credit spread, a put credit spread. However, my max loss is also largely capped. On top of that, I allow myself a week for that earnings reaction to be baked out of the stock and the stock to normalize back to its normal price. So I'd rather play the earnings like this than just going black or white, in the casino, buy a call, hopefully it hits, but it might not. When I sell slightly out of the money credit spreads with short expirations, they still pay very well because of the volatility that's being implied when it comes to GE specifically and right before their earnings. Okay, so for me, selling a credit spread slightly out of the money, slightly outwards, maybe a week, is a lot more efficient, a lot more tolerable when it comes to risk factor than buying calls.